Digest of the biggest market stories from the past week. Join host Anna Serin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Hi, my name's Anna Serin. I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us for yet another market recap here on Friday, March 31st, 2023. I am joined today by my wonderful co-host, Jordan Youl with StoneCastle Investment Management. Thank you for joining me, Jordan.
Yeah, it's great to be back. Thanks for having me.
Well, I'm always happy to have you back. Listen, it's been a big week. There's been a lot going on at the CSE. So we're going to break down what's happened in the markets, and then we're going to talk all things CSE. We're going to start talking about the Q1 recap that occurred this week. You're going to tell us what that means. I'm sure there's lots of data that came out of Q1. We're going to talk about market signals. We're going to get into the personal consumption expenditure. You're going to explain what that means and how that affected the market. And then we're going to talk about the CSE. Some big stuff happened with us this week. So let's start with Q1 recap. What did we learn?
Well, yeah, it's been an interesting quarter for sure. It's quarter end today. And, despite all the macro cross currents and challenges year to date, as I mentioned a couple of weeks ago, there are sectors and industry groups really performing and thriving in this challenging market environment. So the takeaway here is that, we've really seen sectors that really lagged and underperformed last year really come out of the gates and lead year to date, such as technology, consumer discretionary, industrials, and we've really seen a reacceleration back in the miners. So the leaders from last year, like energy and to a degree financials, continue to struggle. But as investors right now, we're seeing a tremendous opportunity across different industry groups, sectors, and styles right now to generate returns in this market environment.
Okay, so let's talk about sector rotation. What are we seeing?
Yeah, so right now we continue to see a shift into the cyclicals. So industrials have been strong for quite some time, but the NASDAQ technology in particular really struggled as a result of rising interest rates. But with the 10-year Treasury yield coming off its peak, we are seeing that reacceleration out of value back into growth. Large caps in the US continue to outperform the small caps, but I will talk about this momentarily, but we are starting to see market breadth broaden out and expand. So the smaller caps, mid caps, components within these benchmarks are starting to participate once again after really struggling in 2022.
Okay, and what about, what are we seeing with the US dollar? There's some stuff happening with the US dollar in correlation. What are we seeing there?
Yeah, absolutely. So, if you go back when, we talked, I guess about a year ago in our asset leadership model, we're ranking different asset classes to one another using technical analysis and relative strength. It was really cash was king last year, on a comparative basis to all else. The US dollar was the leader, and that was a tremendous headwind for equity investors throughout 2022. Now, the US dollar peaked in September, and we are starting to see a shift in leadership from an asset class perspective. So currently equities are the top ranked asset class on a comparative basis. And as equity investors, that's what we want. But, as shown here in the chart, what's really fascinating and interesting is the correlation to the US dollar. So when different asset classes are being compared to the US dollar, for example, if the US dollar is trending in an upwards direction, we tend to see weakness in fixed income, commodities to a degree, and equities. But as long as we continue to see weakness in the US dollar, which remains below its 200-day moving average, then that is a tailwind and that benefits the equity market. So as shown in this chart here with that negative number, that is indicating an inverse or negative correlation relationship to the US dollar. So whatever the US dollar is doing, that particular asset class is moving in the opposite direction.
Interesting. And is that normal? Is that something that we typically will see, or is this a bit unique?
No, it's not unique. It's intermarket analysis where these relationships over the course of history tend to be pretty consistent. Like if you go back, last year was really interesting because, equities were really out of favor, but obviously with inflationary pressures and the fear of, the macro environment and what have you, fixed income like the safe haven assets, especially longer term duration fixed income, government debenture debt, they really struggled and lagged. So it was really a flight to safety. Right, it was more of a sentiment factor. So when the equity markets and fixed income markets were out of favor, we really started to see a gradual progression into the U.S. dollar, and that was what really was the opportunity in 2022 for investors was, risk off market environment. And I think the fact that the US dollar is starting to break down, it is in a downtrend, like I mentioned earlier, sentiment is starting to be more constructive and positive once again. And as equity investors, we want sentiment to be, optimistic, not euphoric, but healthy. And it was very pessimistic last year, as you know.
Absolutely. So this is, I feel like we've been on a good trend this year so far. There's been some positive data that has come out. So hopefully this is continues to remain good for us. Speaking of remaining good for us, you're seeing some market signals. What are you seeing there?
Yeah, so this is one of our primary market indicators, and really it looks at the advance versus decline ratios. So, if we look at the index from a top-down perspective, it is not out of the woods yet. We still have to get through some upside objective targets before we get the all clear. But as I mentioned, and based on the performance year to date, we definitely have the right sectors driving the markets right now as we challenge these, overhead resistance areas. So, the February high, the August high, the spring high, and inevitably hitting the all-time high. So we're trending in the right direction, like you said, and we still have the right sectors driving the markets. But what was a problem last year was lack of market breadth. So even when we had these counter trend rallies in the spring and even in the fall to a degree, not all issuers were participating. It was very selective. It was quite narrow. Energy was really that one sector that was pretty consistent, but not all was working. That's not really the case today. We're actually starting to see more advanced decline ratios starting to improve. So we're starting to see more accumulation and buying power and accumulation into other industry groups and sectors that we haven't seen in quite some time. So in this chart, in the lower panel, is an oscillator. It's an advanced decline ratio. And the takeaway here is, if you look at that green shaded box, it's above the zero line now. Okay, so that's just telling you that this ratio is now positive once again. And anytime it's turned above that zero line once again, similar to October and in the summer, that's just telling us that market breadth is starting to expand. And that's really what we want to see as investors. We want market breadth to be robust as we are trying to break out and try and hit all-time highs.
Okay, so there's an old adage in the markets that says sell in May and go away. Is there typically a bit of a flurry in April as we go into April this year that people prepare for that?
To a degree, but and I do have this chart available for anyone that is interested, but there is that old saying, sell and may go away, but that really hasn't been as consistent over the most 5 years or 10-year period. If anything, like June and July, for example, have generated very strong returns. Where there's a little bit more consistency from a seasonality perspective is a weak September and a weak first half of October. There's a 6-week period where time and time again, that's a little bit more reliable. But from a seasonality perspective, like the gold miners, for example, as I mentioned at the top of the call here, miners and materials in particular are starting to really take over a leadership role. And now we're going into a strong seasonal period, a positive seasonal period for the gold miners. So it's something to be aware of and cognizant of, but yeah, the sell and may go away at the index level hasn't been as consistent over the last several years.
Okay, well, that's good to know. Okay, let's talk about the personal consumption expenditure. This is a measure of consumption for GDP, and it's out of the US that this data comes, right?
Correct. Yeah.
Okay,
yeah, and it really measures the change in price of goods and services purchased by consumers, excluding food and energy. And it was released today, and that's really why the market's reacting quite favorably today. Plus, it's month end, quarter end, there's some rebalancing going on. But this is an economic data point that's quite constructive and positive. The rate of change in inflation is coming down. And what's really fascinating and interesting is not only was the print below consensus, which is a good thing, but in the very bottom right-hand corner of this chart where that orange circle is indicating, that was telling us that there was a revision. There was a change. So the data from January that was released last month in February, which came in at 0.6, actually today got revised down to 0.5 as well. So that rate of change in inflation is actually coming down. And I think that is why we're starting to see the growth areas of the market really start to, continue to break out and lead, because the market is expecting that the Fed may hike for their upcoming May meeting, which is expected 25 basis points, but there's also a high probability that they may hold. right? So I think the expectation is that they're not going to continue to hike or increase interest rates aggressively for their upcoming meeting. So this is a very interesting positive data point that came out this morning, and the markets are reacting positive to this news.
Well, and I guess essentially what this means is, we've been talking about this for a while now. The Fed has a job as the Canadian government. We have a job of with these high inflationary periods to increase rates to try and stave that off. Now, there's been a bunch of moving waters that are happening, and there's been moments where I think last year we had 7 increases in Canada in interest rates, which is quite aggressive. So there definitely is some value in seeing that this is actually working, and it's working against inflation. Is that right?
Yeah, absolutely. It's that rate of change, and we haven't really experienced it like how aggressively rates went up in the last year, but it's starting to come down. There's pockets and components within like the CPI data that still remain elevated, whether it's housing and whatnot. But yeah, the Fed is in quite the predicament, right? Because the labor market is still quite robust. And that's really what we're going to look forward to for next week is the US unemployment rate and some jobs data. But, unemployment is still at, extreme lows. The labor market's still quite strong, and core inflation is at levels that we haven't seen since, the 70s and early 80s. So we still have more inflation data that will come out before their next FOMC meeting for early May. So we'll see how the market adapts and reacts to that. But I think the takeaway here is we're not expecting the Fed to hike 50 basis points or 75 basis points moving forward.
It's slowing down.
It's slowing down. Yeah.
Wonderful. Okay, listen, I want to talk about some CSE news. So this has been a pretty exciting week for us. I think we have touched on it before in market recap. This has definitely been something that's been in the works for several years now, and definitely led by our senior management team. We've been working with the regulators on updating our policy book. The CSE has been around and opened its doors in 2004. So we're almost 20 years old. This is the biggest revision of our policy book that we've ever done. And some pretty exciting things have come from it. So this was just announced this week. We've now implemented this new policy book and the material changes to it. We got approval from the OSC and BCSE. I have to give a shout out to our fearless leader, Richard Carlton, and our senior VP, Mark Faulkner, with listings and regulations, because this definitely has been a big labor of love for them. So it's all been implemented now. I encourage any viewers that have any questions on some of the smaller changes that have happened, call anyone that you know on the CSE team. We're happy to kind of break it all down for you. But here's some of the really exciting stuff that came from it. So essentially the biggest part of it is going to be that the CSE will now have a senior tier. And really the companies that came onto the CSE have just grown so big that they were definitely the driving force in us having to kind of build out the senior tier. So we now still foster our wonderful, junior tier of small and mid-cap companies. And as they grow into big, wonderful, massive companies, that we can service them as a senior issuer as well. And we will, it meets the standards globally of senior tiered companies as far as their enhanced disclosure and governance requirements. So they will be on par. It allows ease for institutional capital to now flow to CSE issuers that will be, fall in that senior tier. It'll allow us to list ETFs and our issuers to participate in ETFs. It could allow for some of our issuers to fall into indices, which is amazing. We have asked, we've requested from the new Self-Regulatory Organization of Canada to grant margin eligibility for these issuers, which I know would be definitely of value to those companies. There's a bunch of other little changes that have occurred. And again, biggest change to our rule book that's ever happened, and definitely encourage if anyone has an interest in knowing more to give us a call. We're happy to walk you through it. You might also notice today on Market Recap for our regular viewers, we have a bit of a fresh facelift. So behind the scenes, congrats to Renee Collier. She has been the driving force behind this new rebranding. The CSE has a fresh face, and you're going to see lots of updated stuff come from us. So the CSE is having a bit of a rebirth this week. It's pretty exciting. There's been a lot of work that's gone into it. I wanted to ask you, Jordan, as from a fund manager perspective, how does this change for you guys as our issuers now can be, when they meet a certain size, are considered senior tiered issuers on our exchange?
Yeah, well, first and foremost, congratulations. Those are some significant changes and all very positive for sure. It's a tremendous game changer for sure. And, the first thing that comes to mind is just it really instills confidence in these issuers that are really graduating, to the big board, right? It's just really instilling confidence that these companies have grown, they've proven themselves, they continue to grow. And that really could attract institutional money, and also trading volume as well could definitely pick up too. And as you mentioned, the fact that they could be included into ETFs, that in itself is significant, right? The ETF world continues to grow and expand. And if you get included into an ETF, that in itself will get a lot more eyes, that will attract new investors, new capital, and the trading volume will pick up as well. So across the board, it's very, very positive.
It's pretty exciting. And, I think too, it's just proven that, the small cap startup companies, they really do have that ability to become, huge senior tier companies. And now we get to be the marketplace that gets them, from the start and helps them grow all the way to the end. So it's definitely very exciting for us, and very exciting things to come for the CSE as we approach our 20-year anniversary. Again, I can't even mention everyone involved. There are so many people behind the scenes that work tirelessly to make this happen. And our issuers, I think there's approximately 100 issuers that will fall into the senior tier, and we'll be working with them over the next year to help them transition over to that. Anyway, it's been an amazing feat, and congratulations to the CSE and to CSE issuers. Jordan, what should we think about going into next week?
Yeah, so there's a couple of things. Just want some follow through, just building off of our discussion over the last number of weeks. From our technical work that we do, we continue to see improvements. So we're really optimistic and excited about what we're seeing beneath the surface from a leadership perspective. It's quarter end, so companies are going to report their earnings in the coming weeks as well. So we're going to take a look at that. But I think all eyes are really going to be on the unemployment rate and the job numbers next week as well.
That's awesome. Listen, Jordan, I always love having you here. Thank you so much for joining us today on this rainy, cloudy Friday, but still very exciting week for us. I look forward to seeing you or Bruce next week, whoever is available.
Thanks for having me. Great to be here.
Thank you, Jordan.